If inflation is slowing down less quickly than desired and the labor market is improving again, there are no reasons for a sharp rate cut. This was the message the market received yesterday during the speech by Fed Reserve policymaker Christopher Waller. At the same time, he urged for more caution regarding further easing of monetary policy. Translated into market terms, it means that less than a month from now, on November 7, the US funds rate will be reduced by only 25 basis points. A series of US economic data has proven that the domestic economy is still resilient as is only slowing down slightly. As for the labor market, the October non-farm payrolls will almost certainly be skewed. No doubt, the recent hurricanes and the Boeing strike could significantly distort the picture. In any unclear or alarming situation, the winner is the US dollar as a rule. And this week, its index notched more than a 2-month high of 103.36. All in all, the US dollar index, which tracks the greenback's value against 6 major currencies, jumped by 2.5%. At the same time, this only aggravated the situation with the overbought US currency, so the market now desperately needs a local correction. For this, it's ready to take into account any, even insignificant fact. For example, industrial production in the euro area rebounded from minus 2.2% to plus 0.1% year-on-year. The euro buyers were also pleased by the report from Germany. The Eurozone's largest economy recorded a rise in economic sentiment. Moreover, the surge in the index was beyond forecast, jumping from a 3.6 in September to 13.1 in October. Although the overall economic situation in Europe looks bleak, the mere fact of a slowdown in the decline on the back of the dollar's excessive overbought condition provides enough reason for a local correction in the euro-dollar pair. As for the euro, it has emerged from the shadows today. Before the release of reports in the Eurozone, the single currency was drifting below 1.0900, but now this line has turned into support. The euro-dollar pair has even shown a modest rise within the intraday range of 1.0889 to 1.0919. However, the dollar's correction still looks unconvincing. At the same time, demand for the US currency is pushing the euro back into the sell zone. Overall, markets prefer not to take risks for now and are waiting for further comments from Fed Reserve policymakers. As for the European Central Bank, it may announce another rate cut as early as Thursday, which would further increase pressure on the euro. Considering how the markets are reacting today to secondary economic reports, we can expect increased volatility later today following the release of the New York manufacturing PMI. After an unexpected surge to around 11.5 points in September, the indicator's growth is expected to slow down again. Forecasts suggest a drop by nearly 4 times to 2.3. In that case, the euro-dollar pair will have another reason for correction. However, the burst in volatility will happen later, during the speeches by Mary Daly from the San Francisco Fed and Adriana Kugler, a member of the Fed Reserve Board of Governors. Oil prices are also responding to the incoming news. However, the key news for oil is mostly coming from China and the Middle East. Although China's Ministry of Finance made a statement on Saturday, it has far-reaching consequences for the commodity markets. The thinkers Beijing has once again promised to implement additional measures to stimulate the ailing domestic economy. But such promises remain unsupported by concrete figures. The situation in China is causing growing concerns. Thus, the fear of a sluggish demand from the world's largest oil buyers has entailed a new drop in oil prices. However, investors remains on the Middle East. After Israel refrained from a strike in Iran's oil infrastructure, oil prices immediately sank by $3. For instance, Brent crude fell to $75 per barrel and traded lower today within a wide intraday range of 73.60 to 75.60. What about Russian currency? As expected, exchange trading carried on as usual after the US Treasury Department's ban on transactions with the Moscow exchange came into force. As a result, the ruble asserted its strength. Moreover, the rally is not over yet, and the Russian ruble is set to gain ground during the whole trading week. The dollar-yuan pair opened today in the red, fallen to a one-month low in both the domestic and offshore markets. The yuan-ruble pair also retreated somewhat from last week's highs. However, the currency pair is still following an uptrend, moving today with an intraday corridor of 13.55 to 13.75. That's all we have for now. We monitor developments in the financial markets, subscribe to our channel, and stay up to date with the news with us. See you later.